Everyone, let's jump right in. Today we're putting NatWest Group under the microscope. We really want to figure out if this bank meets the criteria of a fundamentally sound investment. We're bypassing the flashy headlines and we're digging straight into the raw data, recent financial filings, dividend history, and the latest market consensus reports. Let's get into it.
Ultimately, as investors, we're trying to answer one massive question. Is NatWest positioned for a major breakout in 2026? Or, are there hidden macroeconomic headwinds lurking in the background that should maybe give us pause? To find out, we've got to look at their Q1 2026 earnings, that historical dividend data, and what the analysts are currently forecasting.
So, here's how we're going to break this analysis down. Part 1, a quick snapshot of their Q1 2026 performance. Part 2, dividends and share buybacks. And Part 3, future consensus and the overall outlook.
All right, starting off with Section 1, the Q1 2026 performance snapshot.
Right out of the gate, executive leadership is setting an incredibly confident tone. Chief Executive Paul Thwaite is really emphasizing their consistent delivery for shareholders, even with all the broader economic uncertainty out there. But, talk is cheap, right? Let's see the actual numbers driving this confidence.
Well, here is exactly why they're so confident. NatWest pulled in a staggering £4.4 billion in total income just for the first quarter of 2026. And this isn't some random fluke, it's a very solid increase compared to Q1 of last year. Plus, that top-line revenue translated beautifully into a super healthy £2.0 billion in operating profit for the quarter.
But honestly, what's even more impressive for us as investors is their return on tangible equity. It hit 18.2%. For a traditional bank, that is just a fantastic profitability metric. It screams strong capital velocity, and it basically tells us that this management team is highly efficient at generating profit from the equity you and I invest.
And all of this brilliantly highlights the sheer scale and absolute stability of the bank. We're talking about a true fortress balance sheet here, with total assets sitting at a mind-boggling £714.6 billion. But the crucial part? They are funded by a massive, rock-solid foundation of £443.0 billion in customer deposits. Because they have that, they aren't overly reliant on expensive wholesale funding markets just to keep their daily operations running smoothly.
But banking is literally the business of managing risk. So to really grasp the risks NatWest is exposed to, we've got to look at their expected credit loss, or ECL, coverage ratio. In Q1, NatWest bumped their ECL coverage ratio up to 0.84%, bringing total provisions to £3.7 billion. Basically, they're looking at the broader economic uncertainty and saying, hey, let's set aside a healthy chunk of cash just in case things get bumpy.
So why exactly does this matter for you? Well, they took a £283 million net impairment charge this quarter, but, and this is a really big but, that charge is literally just 26 basis points of their gross customer loans. Management is actually very comfortable with the credit performance of their book right now. Actual default levels are remaining remarkably low, so it's kind of like they're buying umbrellas for a rainy day, but the storm hasn't actually hit their loan book yet.
Okay, moving right along to Section 2, dividends and share buybacks.
Just look at the undeniable, frankly beautiful progression of their dividend payouts. Back in 2019, the dividend was sitting at a measly 2.0 pence. But fast forward through years of consecutive increases, and their 2025 dividend skyrocketed to 32.5 pence. That is a massive 51% jump from 2024 alone. Now, based on yesterday's closing share price of £6.65, that recent payout history gives NatWest a super attractive dividend yield of 6.4% today. If you're an income-focused investor, grabbing a 6.4% yield from a systematically important UK bank, especially one where the dividend is heavily covered, like 2.2 times by their income, that is a ridiculously compelling proposition.
But here's the thing, cash dividends are really only half the story. On top of those payouts, they're actively repurchasing up to $750 million of their own stock. This buyback program kicked off in February 2026, and it's actively reducing the supply of shares out there on the open market. By retiring those shares, they are essentially increasing the proportional value and the future earnings per share for everyone who just holds onto their stock. It's a fantastic wealth generator.
All right, let's look ahead. Section 3, future consensus and outlook.
Checking out the official consensus data from May 2026, we get a really great insider look at what the market is actually expecting. The analysts are modeling total income to steadily grow from £18.0 billion here in 2026 all the way up to £20.3 billion by 2028. It paints this incredibly clear picture of steady, resilient, upward momentum. To understand exactly how they plan to achieve that income growth, analysts are hyper-focused on the net interest margin, or NIM. This metric is projected to climb from 2.53% in 2026 up to 2.69% by 2028. That upward trend in the NIM, huge green flag for us. It shows that the absolute core engine of the bank, meaning lending out money at a higher rate than they borrow it, is expected to see sustained, improving profitability over time.
Now, things do get a bit complex here. Even though the bank's net interest margin is expected to grow, analysts also think the UK base rate is going to slowly drop over the next 3 years. We're talking 3.86% at the end of 2026, drifting down to 3.61% by 2028. Generally speaking, dropping base rates are a macroeconomic headwind for banks because they can really squeeze interest income. So NatWest is going to have to manage its balance sheet masterfully to actually pull off growing their margin in a falling rate environment.
So synthesizing all this data together, here is our fundamental health check. On the strength side, we've got an incredibly profitable bank, an 18.2% return on tangible equity, returning just massive value to shareholders through a 6.4% yield and a $750 million buyback. But we have to balance that against the macro risks, right? We've got the projected drop in UK base rates and those rising impairment provisions meant to cover potential bad loans in an uncertain economy. Take a second to really digest these numbers one last time. Is that fortress balance sheet, the crazy dividend growth, and the sheer core profitability enough to insulate NatWest against the upcoming interest rate drops? Does this stock truly belong in the ultimate defensive investor's portfolio? Well, that, my friends, is the billion-pound question.